cross-collateralized loans. In this guide, we're going to walk you through what cross-collateralization is, how it works, and how it can stop you from growing a property portfolio. If you're looking at using equity, growing an investment portfolio, and trying to build passive income from property, you need to watch this video. What is cross-collateralization? Cross-collateralization is a term that means when one loan is secured by two properties. The most common time you'll see cross-collateralization is when you're buying your first investment property. You might have an existing loan that has equity, and the bank will say, we can lend you 100% of the new purchase price by using equity from your existing. Let me break down how that works. If you've got an existing home that might be worth $400,000 and you've got an existing home loan of $240,000, you come to your bank or mortgage broker and say, I want to buy a new home of $650,000. Easy done. You can get a new loan of $650,000 using both your existing home plus the new investment property as security. The downside is they're tied together. They're cross-collateralized. We're going to come back to some of the issues later in the video on this. The obvious benefit from cross-collateralizing is that you can borrow 100% of the new purchase price in one loan. It can be helpful to build your portfolio because it means you're not having to outlay your 10 or 20% deposit. You're actually borrowing the full purchase price for the new home using your equity. If you're cross-collateralizing, it means you have to stay with the same lender as well. And the advantage is some banks will actually extend your borrowing capacity because it's lower risk to them, because instead of having one property, they've actually got two on the hook if something goes wrong. There can be also tax benefits in this because you're borrowing the full purchase price. You're borrowing potentially that $650,000 amount instead of having to put in deposit, and you can claim taxation benefits for borrowing more money in that case. But there is an alternate to achieve the same outcome, and that's called stand-alone security. Having your property standalone or having a standalone security means that one property is secured by one loan and they're completely separate from each other. So if, for example, one property increases in value in a few years' time, you can value it independently of the other. So using the same example where you've got an existing home that you're living in worth $400,000 and you're buying a new investment property for $650,000, you can achieve the same outcome. You can still borrow $650,000, but structure it as standalone instead of being cross-collateralized. In the example before, you had only two loan accounts, one for $240,000, your existing loan, and one for $650,000. To make the property standalone, you're going to have three loan accounts. You'll have one new one against a new property of $540,000, and then the difference to make up the $650,000 is $110,000 that's secured against your existing home. Which is better, standalone or cross-securitized? Generally speaking, we look at standalone instead of cross-collateralization. The main reason being it can get pretty tricky to untangle and untie properties once they cross together. They're set up in the loan contract like that over a 30-year period. And this is where things get tricky, because if you have both the properties, so say these two properties, one's worth $400,000, the new investment's worth $650,000. If in 5 years' time, the $650,000 property is now worth $1 million, but your existing home's only gone down to $300,000, if the properties are cross-collateralized, the bank will want you to revalue both. They're both tied together. On the other hand, if they're standalone, they'll value this one at $1 million, this one's $300,000. If that's $300,000, it stays there. They don't care about it's on a 30-year contract, doesn't get touched. And you can use the equity in the $1 million property to help accelerate your property journey. The major drawbacks of having your properties cross-collateralized are you're losing flexibility. There's increased complexity because things are tied together. Even when you go and sell one of the properties, they'll potentially revalue. It also reduces how much the banks give you upon the sale. In the example before, if you sell that $1 million property for $1 million, the bank will revalue that lower value property and potentially reduce your lending to 80% of the new value. So you're going to walk away with less cash. And ultimately, it gives you less control over your loan. The other downside to cross-collateralizing, especially when you're paying lender's mortgage insurance, that's the insurance that's there to protect the bank if you've got less than 20% deposit or equity, is it costs way more. It's more risk for the bank because you've got more properties and more loans and more exposure to them. In this example, where you might have your existing home worth $300,000, you buy an investment or a new home of $550,000. If it's cross-collateralized, the lender's mortgage insurance cost is $20,000, purely because there's more properties and more lending tied together. On the other hand, if you were to do it standalone, still borrow the same amount, so you're still borrowing $525,000, the lender's mortgage insurance is almost $6,000 cheaper. It goes down to $14,700. There's not a lot of to having your properties standalone. And this is where you can get in trouble. It's very common for banks to want to cross-collateralize your business together. For them, it's just less paperwork, is the honest truth. It's a lot of less effort. For them, it's less risk because then they've got two properties instead of one. So if something goes wrong, they can have to sell up two because they're all tied together, and you can get caught out that way. And they're hoping it's a set and forget situation. So you definitely want to have that conversation with your bank, or have a like us that can help you with structuring your portfolio in the right way for growth and to achieve your goals. At Hunter Galloway, we're mortgage brokers. We help home buyers across Australia and help achieve your goals of buying your first home, upgrading, or building a property portfolio. So if you need any help with finance and structuring, hit us up at huntergalloway.com.au.